Are you tired of watching your savings account barely grow? What if there was a way to unlock significantly bigger payouts? Welcome to the world of high-yield ETFs. Investing can feel like navigating a maze, especially with terms like ETFs and high yield. In this video, we're going to cut through the confusion and break down high-yield ETFs in simple terms. So what exactly are high-yield ETFs? Let's break it down. First, ETFs stand for Exchange Traded Fund. Think of an ETF like a pre-made investment basket. It bundles together a collection of stocks or bonds. Now, what makes a high-yield ETF special? It's all about the dividends. These ETFs target investments known for larger-than-average dividends. Companies that pay dividends share profits with their investors, much like collecting rent from a rental property.
A common strategy is called covered calls. It's like renting out your stocks to generate extra income. With covered calls, the ETF can rent out the potential future increase in a stock's price in exchange for immediate income. They sell someone else the option to buy your stock at a certain price in the future. This rent or premium boosts the ETF's dividend payout. Covered calls generate income but may cap upside if the stock price skyrockets. The key takeaway is they aim to generate more income. High-yield ETFs offer potentially bigger payouts. These ETFs deliver dividends often higher than traditional investments. Extra cash flows into your account regularly, just for owning these ETFs. It helps reach financial goals faster. This income is largely passive. Once you've invested in a high-yield ETF, you don't need to constantly buy, sell, or watch market news. Hold the ETF and let those dividend payments come in. Your money works for you, even while you sleep. High-yield ETFs offer built-in diversification, reducing risk compared to investing in just a few high-yield stocks. With dozens or hundreds of different investments, your risk is spread out, protecting your income stream. High-yield ETFs are accessible. Anyone can buy or sell them through online brokers, making investing straightforward. Now that we've covered the benefits, let's explore the risks and downsides you need to be aware of. Let's dive into the reality of high-yield ETFs. It's crucial to understand the potential risks before investing your money. Be prepared for potentially higher volatility. High-yield ETFs can experience more price swings than broader market ETFs. The types of investments held by high-yield ETFs are sensitive to market changes. Values may fluctuate significantly during downturns. It's essential to consider that high yield isn't guaranteed. Dividend payouts can fluctuate and may decrease over time. Factors like market conditions and the ETF's investment strategy can affect dividend payouts. Don't assume yields will remain steady.
Keep a close eye on expense ratios. These are the annual fees you pay to own any ETF, covering management costs of the fund. You'll see it listed as a percentage. High-yield ETFs can have higher expense ratios, especially those with complex strategies. Even a small difference in expense ratio, say from 0.1% to 0.5%, can impact your returns over time as you invest. Always factor in those fees when evaluating the net yield you're actually receiving, after expenses are taken out. The mechanics behind how high-yield ETFs generate income can be complex. These aren't always simple investments. Be aware of the underlying strategy used by the ETF, whether it's covered calls or investing in high dividend sectors. With both benefits and risks in mind, the big question is, are high-yield ETFs a good fit for you as a beginner investor?
High-yield ETFs aren't universally good or bad. Your individual financial goals and risk tolerance play crucial roles in this decision. Consider if you are actively seeking income. Perhaps you're nearing retirement and need to generate income or supplement current earnings through investments. If generating cash flow is your primary goal and you're aware of the risks, high-yield ETFs could be an option worth exploring. You must accept that these investments require careful monitoring. They are riskier but can offer higher income potential than safer investments. If you're a beginner who's comfortable with market fluctuations and willing to learn about specific high-yield ETFs, dip your toes in cautiously. Never invest more than you can afford to lose. For many beginners focused on long-term growth, broad market ETFs or diversified index funds may be a better fit.
If you're thinking high-yield ETFs could be for you, the next step is research. Let's discuss how to choose one wisely. You've considered the benefits and risks. Never invest blindly. Smart investing starts with thorough research. First, understand what's inside the ETF. What types of investments does it hold? Stocks, bonds, REITs, or specific sectors? Check the ETF's holdings information on the provider's site or financial websites. Are you comfortable with the assets? Next, always check the expense ratio, the annual fee to manage the ETF. Compare it to similar ETFs. Every dollar saved is more in your pocket. While a higher expense ratio isn't always a deal breaker, ensure it's justified and reasonable to protect your returns.
Always check the expense ratio. This is the annual fee charged to manage the ETF, listed as a percentage. Compare the expense ratio of the high-yield ETF with similar ETFs in the same category to ensure it's reasonable. While a slightly higher expense ratio isn't always a deal breaker, ensure it's justified and not excessively high. It's tempting to rely solely on past performance charts, but remember, past results aren't guaranteed. Understand the ETF strategy and its associated risks instead of just chasing past returns. A long track record of consistent performance is reassuring, but not the only or most important factor.
It's tempting to just look at past performance charts. But remember, past performance is never a guarantee of future results. The market is always changing, and what worked well in the past might not continue to work in the future. Focus on understanding the strategy the ETF employs and the types of risks it takes, rather than solely chasing past returns. Try to at least skim the ETF's prospectus, the official document outlining everything about the ETF. Focus on investment objective and risk factors sections to get a well-rounded picture before you invest. You've got your research checklist. Let's wrap things up with a quick summary and some final thoughts. There you have it, a beginner's guide to demystifying high-yield ETFs.
High-yield ETFs can be powerful tools for income generation and potentially boosting your portfolio's returns, but they are not get-rich-quick schemes. Remember, the higher yield comes with higher risk, a fundamental principle of investing. Go in with your eyes wide open. Always start with a small, test investment. Don't put all your eggs in one basket when exploring something new. Investing wisely is a journey. Learning about high-yield ETFs is a great step in building financial knowledge. What are your thoughts on high-yield ETFs? Share your opinions and questions in the comments below. If you found this video helpful, please give it a like and subscribe for more educational content on investing.